and welcome to Money, Money, Money. I'm Surabhi Upadhyaya. An all-time high. Every time we reach this milestone in the stock market, it leads to several very diversified emotions. There are some of us who feel absolutely elated. There are some of us who feel a little despondent because of the feeling of having been left out, having missed the rally. And then there are many of us who are just simply confused, not knowing what lies ahead, what to do. So we thought that this is a good time to go back to the drawing board. We looked at a lot of questions. You've been flooding us with queries on our digital platforms, on our timelines, about what to really do next. It's a great time to go back, look at your portfolio, go back to the basic rules of asset allocation, of what your goals are, medium term, long term, short term, and see if there is something that needs to be done. So to help us over the next 1 hour, the first half hour is going to be on television. The next half hour is going to be on our digital platforms. We have a panel of experts. Kalpen Parekh, President at DSP Investment Managers, who represents the mutual fund sector. Feroze Azeez, Deputy CEO at Anand Rathi Private Wealth Management, as well as Ashish Shankar, Deputy MD at Motilal Oswal Wealth Management. Gentlemen, thank you very much for taking out the time. And thank you for taking out 1 hour, not the usual half an hour. And I'll tell you why we requested for 1 hour this time around. I'll start off with a query from Jay Patel. And it really embodies the ethos of the confusion and the questions which are out there. Let's hear out what Jay had to ask the panel.
Since market are touching all-time highs, so do you think we should start switching to debt funds or government schemes since real rates are very negative, or we should invest in equity funds?
But, Feroze, I think also why people are asking this and why I don't want the question to be dismissed is because, yes, we all know that we should, buy and invest for the long term. But let's face it. I mean, simply buying and forgetting hasn't always been the best strategy, especially in the last couple of years, if you just go by mutual fund returns. Feroze?
Yes, Surabhi. Of course, I think if you look at it from the last 3-year, 4-year pocket perspective, you will realize that buying and holding might not have been the best strategy. But market behaves differently in different pockets. Firstly, it's very important to understand what's the context in which this correction happened and what's the behavior of the market after a correction this steep. Always bull runs begin after a sharp fall. I think over the last 6-7 months, we at Anand Rathi have been propagating the fact and convincing people that that sharp fall could result in a huge rally. So if you look at the last 6 falls, sharp ones, the average return 3 years after that have been about 150% from the lows, and the worst being 70% and the highest being 300%. So every time you've seen these last 6-7 falls in India over the last 20 years, you've seen very, very sharp, great bull runs subsequently. And if that's an indication of 150% average return 3 years from then, I think we've just got 50-55% of it. So I think you still have a 100% return possibility if you go by the averages of the fall. So it's important to understand this context. Otherwise, higher levels give you some degree of intimidation to stay invested in equity. Every day, equities are going to make new highs, just like a fixed deposit makes a new high every day. So that's point one. Point two, we have globally $16 trillion of debt money in negative interest kind of instruments. That money is going to definitely find its way, and India is going to be a beneficiary for sure. And I think the third point, one last point, Surabhi, is the fact that Indian interest rates are low and Indians are not used to it. So you will see a large flight of capital from debt to equity. So I would like to believe that next 4 or 5 years are going to be different than the previous 3.
We do need to take a break, but on the other side, we get down to specific math. The big question, are you better off taking some money off the table and paying the tax liability, short-term or long-term capital gains as it may? Should you do that or just keep the money there and let it compound? Where do you earn a better return? We'll take up an example in just a bit after the break. Well, let's do the math. And we got Feroze to, give us an example and illustrate this. So, Feroze, why don't you tell us the numbers? The basic thing is if I'm sitting on a gain, is it better off to pay that capital gains tax and pocket it, or is it better to remain invested?
Surabhi, what happens is when you exit, of course, there are exit costs and taxation. If it's in the short term, you have exit costs. So let's take an example. if someone has invested about 100 rupees and has got a gain of 150 rupees, so that sums it up to 150. If a person took away the investment or the gain amount, 50 lakhs, by selling all his units, for example, so then he has a 50 rupee gain on which there could be short-term capital gain or long-term capital gain. If there is a short-term capital gain, a person ends up paying 7.5 rupees out of the 50 rupees, and then the cess and the other surcharges which are applicable. So you are looking at almost 7.5, 8 rupees out of your 50 rupee gain vanishing in taxation. And if that's long-term, then you end up paying 5 rupees as your tax. So what you're left with is not 150, you're left with 142.5 in case of short-term investment. You're left with 145 after paying the taxes. So point being made here is, now once you go out of the market, and if let's assume you're lucky enough to get a 10% fall in the market and then you re-enter, right? So if you re-entered your 142.5 or 145, as the case may be, you will end up having a total differential of a loss of 4 rupees in spite of getting a 10% fall in the market. So point is, the cost of actually getting out and getting in is 4% for a short-term investor, and the cost of a person getting out and getting in the long-term category is upwards of 1%. So there is transaction cost, especially the tax component becomes quite taxing in this case.
Okay, all right. So the math is telling us that you ought to stay invested. But remember, Feroze has assumed 15% return in this particular example. So maybe that's a separate debate with him on the 15%. What if the market doesn't go up that much, right? But that's for perhaps a later day. There are so many different kinds of fund categories. There are US funds. I mean, there are multi-asset funds. There are value, dynamic asset allocation. So creating the right bouquet can be a daunting task. Feroze, your perfect-looking mutual fund basket, and I'm wondering if you're adding any new categories, all these, US equity funds, a lot of fancy stuff out there, so many different categories on offer.
Surabhi, to my mind, I think asset allocation, which is very critical, I would still say 65% being in equity for to the extent of 65% is critical for the next 5 years, to my mind. Then coming to the product category on the mutual fund quickly, I think what we believe is focused equity funds are underrated. They definitely deserve more attention. To my mind, because they're high conviction ideas. That's one. Otherwise, I think conventional large and mid-cap and multi-cap schemes chosen perfectly can help you create alphas over the next few years. Coming back to the exotic ones, which come into flavor every time the past performance is very good. So I would ask you to stay away from them, be it sector funds, be it theme-based funds, or even global equity. I think we are too late for global equity rally. India would be better poised. So that's the recommendation. If I have to get more specific in terms of schemes, and now that we have Kalpain, DSP mid-cap is our favorite scheme on the mid-cap category. Then SBI focused equity in the focused category, and in the large cap category, Bira Asset large cap, as Ashish mentioned as well. Multi-cap, I would say Kotak Standard Multi-cap, the largest one of the largest fund in that category. These four funds have a large potential over the next 3-4 years.
Okay, so there you go, viewers. You've got some recommendations as well. We have a video query coming in from Naveen Kumar. He's talking about sectoral and thematic funds. Let's listen to this.
How basically, what would you recommend that this is a good idea for a retail investor to use the mutual fund route, the thematic mutual funds, for playing the sectoral theme for a little as a tactical allocation? Can you please dwell on this? Thank you.
Okay, so he's asking about how to utilize thematic funds for building a satellite core portfolio kind of an approach. Very similar to what other sort of viewers are asking. Let's pull up Bhaskar Agrawal's query. Bhaskar is saying, is there any India pharma ETF available? I know there are pharma funds, but I'm particularly asking for a pharma ETF. So people want more knowledge about specific products. And let's move to Viral Shah's question. Now, he's someone who wants to invest in real estate. And he's asking, is there any dedicated real estate mutual fund other than something that Aditya Birla Sun Life has? How to invest in the real estate sector via mutual funds? Interesting. So, Feroze, this brings me to you. While, of course, you gave out a very simple strategy as well, large cap, mid cap, and the multi cap. I think people want to experiment, or people want to try and add the little bit of an alpha to their portfolio using these thematic funds. I don't know if it'll work or not, but your thoughts?
To my mind, it has not worked. Why it has not worked is when it's time to sell is when people end up buying, right? Today, like pharma is in flavor. So people would love to buy a pharma fund. A year back, people were buying the banking sector fund. That's one of the few sectors which has actually not reached its peak in spite of Nifty having gone up 4-5% greater than what it was. So point one, if you're going to go thematic, be rest assured, at least the larger audience, if you analyze, which we did, the assets under management in thematic schemes have always chased its own tail. So that's point one. Point two is when you are going after a theme, be rest assured the fund manager is bright enough to realize that the theme is going to be in flavor. So what happens is he's going to increase his exposure to that sector, and you're going to be parallelly buying the same sector in a specific ETF like it's been asked for, or a fund. And then you're double doing the same thing which the fund manager is doing. This is the exact mistake in 2008 people did. Fund managers had skewed infrastructure in their portfolios to the extent of 45-50%, and people ended up buying 20% separately. So 60%, 70% of people's portfolios were in infrastructure stocks. So that's the second fallacy. The third, I think, please always don't look for entertainment from your investments. Don't try and feel brighter by making investments which make you feel good about. You please have to focus on the objectives. If your objective is to generate 3-4% alpha over Nifty, which I think is good in the long run, good cherry picking of funds, looking at a future perspective, which is what we proprietarily do, is try and analyze future indicators. We're using regression, and that helps us get about 3-4% alpha. So go with your objective of making 13-15%, and if that's your objective, I can fairly say that last 10 years that can be achieved, that has been achieved in the conventional, more boring categories. Focused equity definitely helps as a flavor.
Let's take up Shankar's query. Now that brings us back to the question on asset allocation. Shankar, let's see if we can pull this question up. Yeah, so of course he's asking about, a stock portfolio. That's not the mandate of this discussion. But he's also saying that apart from stocks, what kind of percentage should one invest in ETFs, gold, sovereign bonds? I think overall he's looking at taking a bird's eye view of the portfolio. Feroze, what's your take? I mean, Ashish made a very strong case for sort of equal weighted, some Indian equity, some US equity, a little bit of gold, cash. But how would you look at it? And let's also talk about a medium risk, middle-aged, medium risk investor who might need the money in the next 5 to 7 years.
See, if somebody needs the money in 5 to 7 years, one is what asset classes he buys and what vehicles he chooses or she chooses to participate in that asset class. There are 4 asset classes, to my mind, equities. Now, if you break it down into Indian equities and global equities, debt, gold, and real estate. These are the 4 asset classes. To my mind, equity is still at the cusp of a bull run. It's not over. So a large exposure to equities. And we prefer Indian equities at this moment because the large portion of the rally in the global equity, into our mind, is over. So at the cost of not being overly happy about diversification, I would still say Indian equities should be a large portion of one's portfolio at this stage. Second, what vehicles to choose? I personally don't buy stocks myself. I've just participated in mutual funds, and I think the performance has been reasonable enough that I've not missed. This came out of a research because we run a large broking outfit. So we analyzed the top 500 clients who trade extensively on their own research, and the performance couldn't beat the 7 mutual funds chosen, which was a very, very important. 93% of the top clients, even when they were trying to do their own research, they couldn't beat the mutual fund. They feel that they're beating it because they always look at the best stock. So I would say mutual fund, point one. Of course, sovereign gold bond is a very, very good asset class. So 15%. Gold is a different asset class, and the vehicle is also very, very attractive because you get capital gain exemption if held till maturity. Sovereign gold bonds give you a 4-5% return greater than the gold underlying itself, which I think is a super arbitrage. So that has to be in one's portfolio. Direct equity, to my mind, is a no-no unless you're going to be trading and trying to make money. Third, stick to Indian equities. India is going to go through a big paradigm shift when it comes to debt investing. Ancestrally, we are used to that 8% FD. None of us have seen a 4% fixed deposit. I think people will now be compelled to take risk, and we have almost 8-10 times more the money than in FDs than in Indian equity mutual funds. So I think that's why we are really bullish on the equity mutual fund side, because it gives you that expertise, and it has about 500 odd, 457 to be precise, equity mutual funds. I'm sure if you cherry pick 6-7 of them with reasonable research, you'd be better off.
So we'll go back to the portfolio and the funds that our experts have advised on. But before that, Feroze, demystify this whole debate around don't look at absolute point-to-point returns and look at rolling returns. That's what we were told this year when investors complained about, poor performance. So, explain how this works, because when I looked at simple data, 3-year, 5-year, 10-year, my numbers look very different from your numbers because you were, of course, looking at rolling returns. So explain this to the lay viewer.
Surabhi, I think rolling returns are a far better method of evaluating consistency. When you look at trailing return, for example, if you're on 1st of December, trailing return of 3 years would be the exact 3-year period from 2017, 1st December till date. 2020. So it gives you
right. So what's wrong with that? Technically, it's fair. I'm looking at how much money I made if I invested on 1st December 2017 till today, right? Technically, nothing wrong with that.
Wonderful. There's nothing technically wrong with that. But is that a good decision input for you to conclude whether this is a good investment? Has it done what it was supposed to? May not be. Why? Because if you saw the same 3-year trailing return on March 31st this year, the picture would have been completely different. So if you look at different 3-year cycles, if you did 3 years, if you got 1,000 3-year cycles, that's a more exhaustive piece of information. So point being made here is rolling returns will give you different 3-year time cycles. That will tell you what did the luckiest investor got if he held it for 3 years, what is the most unlucky investor's return? So you get a sense of the range of return. When you're speaking of equity investments,
okay. I think we've just lost that line with Feroze, but take your point that it sort of smoothens out the peaks and the troughs. So therefore, that's why experts like Feroze, like Kashish would tell us to look at rolling returns, perhaps, and not just simple point-to-point returns. I was looking at your portfolio, the funds that you recommended, Feroze, and you had SBI focused equity, I think. Tell us a bit more. You said you like the focus equity, class of funds quite a bit. Why is that, and why SBI focused equity? And also tell us about a fund manager. I mean, we're sitting at all-time highs. From here, who are the fund managers to watch according to you?
So, point one, focused equity is a good replacement, in my opinion, to a PMS in a more tax-efficient fashion. A focused equity, you can have maximum 30 stocks. See, what happens is, in a normal diversified equity fund, you might just get to almost about 45 to 55, 60.
We're having tough luck with that line.
30. So you're looking at high conviction.
Okay, unfortunately, we don't have that line through with Feroze, but I'll ask you that question as well. All right, Feroze, last 20 seconds left on the show. The men and women you're watching out for, the fund managers that are sort of right there on your radar.
I think one of our favorite fund managers, like the SBI fund manager, R. Srinivasan, he's proved to be the best stock picker. So we do something called the right to wrong ratio, find out how many right decisions a person says. So R. Srinivasan, definitely Vinit Sambre, and I'm sure Navneet now has moved on from SBI, but he is expected to be moving on to HDFC, but he's one of the best guys. And Shankaran Narain, as a CIO, I think he has been able to guide his team reasonably well. So R. Srinivasan is the best fund manager as per the decisions he's been taking. The last 100 decisions analyzed throw him up as one of the best guys.
Wow, all right. So there you have it. You have plenty to think about, and some insights onto fund managers as well and how they've done. Gentlemen, this has been a very, very enlightening session. Thank you very much for taking out the time and educating us, helping us do the right things, ask the right questions at this all-time high or any all-time high for that matter. Thank you for being with us on this telecast. And with that, we wrap up this special edition of Money, Money, Money. Keep sending us your queries, your feedback as always.